Did you know that the average mortgage interest rate for a 30-year loan was recorded at 7.66% as of November 15th? In fact, this rate is one of the highest levels we've seen since the year 2000, which is quite significant when you consider the state of the housing market over the past few decades. If you think the 2008 housing crash was bad, just wait until you hear about what's coming in 2024. Brace yourself, because it's going to be uglier than ever. What's the real reason behind this impending crash? Well, it's not just a matter of skyrocketing home prices or the overextension of credit. Those have certainly played a huge role, but are not the whole story. No, it's something much bigger, more powerful, and more insidious. Despite the strong and steady growth in the housing market over the past couple of years, the underlying problems have been festering beneath the surface, ready to burst at any moment. A staggering 30% of homeowners are presently facing negative equity in their mortgages. Battling to stay financially afloat and meet their monthly obligations, they represent a looming crisis ready to unfold at any given moment. And while this may sound like a nightmare for homeowners, it's actually going to be a bonanza for Wall Street's most powerful players. That's right. The same people who made a fortune by packaging and selling dodgy mortgages are now poised to rake in even more profits as they bet against the very same system they helped create. They know it's only a matter of time before the entire system comes crashing down, and they're preparing to cash in big time. But what about the rest of us? What will happen to the average person struggling to keep up with the rising cost of living? Unfortunately, the answer is not a good one. As the housing market begins to plummet, so will the value of our homes, savings, and retirement accounts. It'll be a brutal wake-up call for anyone who thought they were safe and secure. Currently, the affordability of houses in the United States has declined significantly from what it was in 2008. In fact, houses are now less affordable than they have been in decades, going all the way back to the 80s. This is largely due to a combination of higher prices and mortgage rates, resulting in some of the poorest affordability numbers seen in recent history. Evidently, the situation is not sustainable, and a breaking point will be reached in the American real estate market. Please take 2 seconds to help me out and hit the like and subscribe if you're enjoying the video so far. Each like and subscribe helps support this channel and keep us motivated to keep making you great content. Thank you. Now, back to what I was saying. The average salary of an American family has only increased by a mere 16% since 1979, while the cost of housing has skyrocketed by a staggering 260%. A recent study has revealed that in some cities, such as San Francisco and New York, the average household would need to earn over $200,000 per year to comfortably afford an average house. This situation is especially alarming given that the majority of Americans view owning a home as a key aspect of the American dream and don't make $200,000 a year. The current state of affairs in the American real estate market should be a cause for concern for all citizens, as increased housing costs have a far-reaching impact on the economy and society as a whole. As we're all aware, inflation has been on the rise for quite some time, and while it's a topic that's being widely discussed across various industries, the question that's on every real estate investor's mind is, what does this mean for the housing market? The real effect of inflation on real estate is that it has driven up housing prices significantly. In fact, if we look at inflation-adjusted housing prices today, we can see that they are much higher than what they were back in 2008. But why is that the case? Back in 2008, the housing market was in a state of flux, largely due to speculative behavior. Many people were buying homes with the expectation that the value of their properties would increase over time, essentially treating their homes as trading assets. However, this approach proved a major mistake, as the subsequent housing bubble led to one of the worst financial crises in modern history. Fast forward to today, and we're seeing a similar trend, but this time, the reasons are even more complex. Firstly, due to the ongoing pandemic, we're seeing a shortage of available homes, driving up demand and prices. The rise in housing prices is not necessarily a bad thing for everyone. For homeowners, higher housing prices mean they're building equity in their properties, which can be a valuable asset in the long run. Similarly, for real estate investors, rising housing prices can provide a great opportunity for growth and profitability. According to the latest data from the National Association of Realtors, existing homes' national median sale prices are hovering near all-time highs. In November 2023, the median sale price was $391,800, a tad lower than the highest ever recorded at $413,800. Nevertheless, it represents a record-breaking figure for November, as seasonal fluctuations usually make June the highest-priced month in most years. This buoyancy in the housing market has prompted the National Association of Realtors chief economist Lawrence Yun to declare that the pandemic-fueled housing recession is over. Yun's pronouncements may seem premature, but denying the upswing in the market's fortunes is hard to deny. Even as mortgage rates soared to 8%, reaching their highest levels in over 2 decades, home values held steady thanks to a shortage of available homes. Inventory shortages have been a persistent problem in the housing industry, and the latest National Association of Realtors data spells a continuation of this trend. The figures show an alarmingly low 3.6-month supply of available homes. The scarcity is driving up demand and bidding wars, which is, in turn, pushing prices up. In 2008, the housing bubble in the U.S. was formed from a speculative frenzy where individuals treated houses as if they were nothing but securities. Not only were these properties being traded like stocks, but people were even day trading them with the expectation of a looming financial gain. You may recall that the 2008 crash was caused by a speculative bubble where people bought and sold homes like stocks. They weren't just buying them for personal use or investment purposes. They were flipping them like hotcakes, hoping to make a quick buck. In fact, many of them were day trading homes, meaning they would buy in the morning and sell by the evening, expecting a significant profit in that short time frame. Unfortunately, this bubble burst, and the devastating result was the 2008 housing crisis. Today, things are looking different in many ways. In contrast to the 2008 crisis, the market thrived due to low interest rates and high home demand. There's less speculation in today's market, meaning people invest in homes for the long term rather than trying to make fast cash. While risky lending practices drove the 2008 crisis, today's market offers more safeguards to ensure that borrowers are qualified for loans and sellers are ethical in their practices. Also, unlike the 2008 crash, today's housing market isn't driven by day traders and people hastily buying and selling homes, but rather by a healthy balance of buyers looking for a home to live in and investors seeking long-term gains. According to the latest data from the Association of Realtors, a significant gap exists between the supply and demand of houses in the United States. In fact, we're currently short by a whopping 6.5 million homes. That's equivalent to the entire population of the state of Tennessee. We would need to triple the number of new homes being built to bridge that gap. However, this is easier said than done. Historically, housing starts tend to be closely tied to economic conditions. When the economy is booming, we see a surge in new constructions. Conversely, during times of recession, we tend to see a slowdown in housing starts. It's essential to understand the underlying factors contributing to this shortage. For example, land prices have skyrocketed in recent years, making it increasingly difficult for builders to purchase land and develop it. Additionally, certain cities have imposed strict zoning laws and regulations, limiting the number of new constructions that can be built. Homeowners these days are in a better financial position than they were 15 years ago. In fact, most homeowners with a mortgage have a really solid personal balance sheet with a ton of equity in their homes and a credit score that's off the charts. And to top it all off, they've got a fixed-rate mortgage with an interest rate below 5%. So is the housing market really going to crash? Lawrence Yun has confidently stated that we won't be experiencing another housing market crash like we did from 2008 to 2012. According to him, we don't have to worry about risky subprime mortgages, which were one of the major causes of the previous crash. We also don't have an oversupply or overproduction of homes that could potentially lead to a market crash. It's a relief to hear that the real estate industry is not currently facing such risks. These factors indicate that the housing market is more stable and less vulnerable than it was during the last crash. It's good news for both homeowners and investors, as they can have greater confidence in investing in the real estate sector. Thanks for watching, and please make sure you subscribe if you enjoyed the video. Be sure to leave a comment below letting me know what else you think could be the cause of another housing crash.